In this section, we're going to talk about preparing your taxes. So let's start with some basic federal income tax principles. The IRS, or the Internal Revenue Service, is the entity that's responsible for administering and enforcing federal tax laws. And we actually, in the U.S., have what's called a progressive tax structure. That means that the larger your taxable income, the higher your tax rate. So as your taxable income moves to a higher tax bracket, the higher rate, though, only applies to that additional income or taxable income. So here's an example from the 2011. So you can see how the taxable income is in these kind of different levels, and the tax rate is increasing. But what actually happens is that you pay 10% on the first $8,500, and then you pay 15% on the next, $26,000 or so, and so on. So that's how it's progressive. You're not paying 15 or 25 or 28% on your entire taxable income. You're paying that highest rate just on that highest level of income, and then you're paying lower rates on the income below that. So the economics behind this, just meaning that if we apply some economics terms, maybe I can make this whole tax rate business make more sense. The marginal tax rate, because you've heard that word marginal in economics before, hopefully, marginal usually means it's applied to the next dollar of something. So our marginal tax rate is the tax rate that we pay on the next dollar of taxable income. The average tax rate, though, is the rate at which each dollar that we earn is taxed on average. So we take our entire tax liability or tax bill and divide it by our taxable income. So here are a couple of examples. We have Scott and Nathan with two different taxable income levels. And so for Scott, to figure out his tax liability, you take that $45,000 minus kind of the lower level of that highest bracket he finds himself in, which is a 25% bracket, and then the next chunk of his income from $8,500 up to $34,500 is taxed at 15%, and again that first $8,500 is only taxed at 10%. So then we add up those products, and that gives us his total tax liability. Now with Nathan, he earned more, so he ends up having a marginal tax rate of 28%. But that 28% doesn't apply to his entire $90,000 in taxable income, just the portion from $83,600 to $90,000. There are a number of different filing status categories, so let's go through those. Single means that you're unmarried or legally separated. Married filing jointly is for couples who combine their income and deductions on just one tax return. However, married people could also opt to file separately. Head of household is someone who's considered unmarried but pays more than half for themselves and a dependent. And then you could be a qualifying widow or widower with a dependent child. And so to qualify for that, your spouse would have had to have died within the last 2 years. Let's talk about your take-home pay, because remember, your take-home pay is after tax. That's because we have a pay-as-you-go system of taxes where your employer is withholding taxes all year, although if you're self-employed, you have to deduct and pay those taxes yourself. So those taxes that are deducted include federal, state, and local income taxes, but also FICA, which is Social Security and Medicare, and any other withholding taxes. So your taxes are based on your taxable income. So that's a very key phrase. Your taxable income is the amount that's subject to income taxes. And so calculating income taxes is a pretty complicated process. but it hinges on taxable income because a lot of your income could be non-taxable. So we've got three kinds of income though. We've got active income, and so that's the income that you earn typically from work. Wages, salaries, bonuses. Pension is prior work, and alimony is a slightly different animal, but it's considered active income. Portfolio income tends to be considered passive income because that's income that you earn on your investments through interest, dividends, and capital gains. And then another type of passive income, and we're actually separating these two, so portfolio income from your investments, and then real property passive income is this last category, coming from real estate and limited partnerships. So our gross income is subject to federal taxes. So here are the categories of gross income. We've mentioned all of these before, except maybe the prizes, lottery, and gambling. So you have to pay taxes on the money that you win at the casinos. So now your taxable income and liability, to figure that out, first you have to determine your adjusted gross income. So we just talked about where your income comes from, all those different sources. And so then we take out adjustments to gross income, that's tax deductible expenses and any retirement plan contributions. That gives us adjusted gross income. Then to calculate taxable income, you start with that adjusted gross income and you take out either itemized deductions or the standard deductions. The standard deduction. For young people, they tend to take out the standard deduction. For older people who have houses and all of the deductions related to that, we tend to use itemized deductions. Then we take out personal exemptions, and that gives us taxable income. After we've got adjusted gross income and then taxable income, we can calculate our tax liability using tax tables or tax rate schedules, minus any tax credits that we're eligible for, plus any other taxes that we have to pay, gives us our total tax liability. Now, let's talk about capital gains for a moment. This was one of those types of portfolio income. So they're taxed at different rates depending on the holding period, how long you held that investment. So these are typically included in portfolio income, and the IRS actually limits the amount of capital losses that you can claim during a given year. And so that loss has to result from a sale of some income producing asset to qualify as actually deductible. And so a loss then is when it's sold for less than its cost, whereas a capital gain is when an asset is sold for more than its original cost. So capital gains tax rates can be as low as 5 or 15% if you've held the asset for more than 12 months. And that was as of 2011. These figures change, typically with political cycles, actually. And so, but if you've had the asset for less than 12 months, then there tends to be a slightly different schedule. We talked about adjustments to gross income. So income remaining after subtracting allowable adjustments to income from gross income. Boy, that sounded pretty circular, didn't it? We make adjustments to our gross income for allowable items. This lets us limit certain itemized deductions and other calculations. So some examples would be higher education, IRA contributions, self-employment tax, alimony that you pay, penalties on early withdrawal of savings, and moving expenses. So these can be subtracted from your gross income subject to certain limits. Now, remember we said to get to your tax liability or your taxable income, we either deduct the standard deduction or itemized deductions. And so I mentioned that younger people typically go with the standard deduction. Older people who have a more complicated return typically go with an itemized deductions. So the standard deduction is a flat amount that depends on your filing status. Itemized deductions, though, are specific, based on specific personal expenditures. And so you itemize, it's pretty simple. You itemize if that will lower your tax bill more than if you took the standard deduction. And so the kinds of itemized expenses that you could claim would be medical and dental expenses, again, up to a limit, state, local, and foreign taxes, mortgage interest. So remember I said if you have a house, most people tend to itemize their deductions. Charitable contributions, but now you have to keep good records of those donations, but those still would might make you want to consider itemizing your deductions. If you've had casualty or theft losses or moving expenses, and usually those moving expenses are qualified, meaning they have to be based on employment reasons. Exemptions. These are deductions from your adjusted gross income based on the number of persons supported by your income. So you get an exemption for yourself unless someone else can claim you as a dependent, and then you get exemptions for your children or anyone else who is dependent upon you. And so now that we've got income, deductions, adjustments, and exemptions, we can calculate the tax liability. So now we've got taxable income, and that determines our income that's subject to federal income taxes. So if that's less than $100,000, we're going to use the tax tables. If it's greater, then we'll use the tax schedules. Don't forget, from that tax liability, we're going to subtract any tax credits that we qualify for, child and dependent care credits, adoption, foreign taxes, and credits for an electric car. So taxable income and the amount of taxes due as of 2011 is shown on this schedule for individual returns and for joint returns. So what's the difference between tax credits and tax deductions? Credits directly reduce the amount of taxes that you owe. Tax deductions are subtracted from your adjusted gross income and reduce your taxable income. So you can kind of think of it as where they come in that formula. So credits are all the way at the bottom after you've calculated your liability. Deductions are closer to the top after you've calculated your adjusted gross income, but before you've calculated your liability. So typically, tax credits lower your tax bill more. You may have to provide additional forms and schedules if there's more detail involved, but again, younger people use a standard deduction, can just do a 1040 EZ. It's a simple one-page form. So if you're under 65, you've got taxable income under 100,000, and you don't have any adjustments to your income, itemized deductions, or tax credits, then you could just use the simple 1040 EZ. And there's what it looks like. But you may have to use a standard 1040 if you've got taxable income over 100,000, or you claim itemized deductions, and you're reporting self-employment income. So here's what that schedule looks like. A lot longer. So some other things to think about. You might have to make quarterly payments on estimated taxes if you tend to have a pretty big tax bill. Taxes are due on April 15th, but you can file for an automatic extension and then possibly an additional extension if you have a good reason. If you find that you've made a mistake, you can file an amended return, and if the IRS finds that you made a mistake, or at least they think you do, they may audit your return. So again, this is a very complicated process, so you may want to hire a professional. You can hire someone directly, a CPA, enrolled agent, a tax attorney, H&R Block, or bunches of places like that, or you can use tax software like TurboTax. But you're responsible for accuracy. So no matter which way you go, if there's a mistake, you're still liable or responsible for any unpaid taxes. So tax avoidance, meaning trying to lower your tax bill as much as possible, is reasonable and legal, but tax evasion, not filing and or not paying, is not legal. So try to reduce your taxes by maximizing your deductions and credits, or shift your taxes to a trust, or defer your taxes through an IRA or an annuity.